And Matt, so much of the market action up until now has been driven by Fed policy and, of course, concerns around global economic conditions, particularly the slowdown we're seeing in China. Do the events that have played out over the last several days, does that change that base case for you at all?
It doesn't. And, it's just terrible and tragic. And geopolitical events like this are so hard as investors try to separate, the personal emotional baggage and how terrible this is to the objective financial plan or way they're managing money overall. And to us, stepping back and thinking about a lot of the other speakers' points that I think are actually spot on as it relates to interest rates going up as fast as they have, as growth has likely hit a bit of a headwind here going into the fourth quarter. We do think that those trends in a late cycle environment are going to be what drives investment returns from here. We have earnings season coming up. But in overall positioning, we have been tilting to higher quality across equities and fixed income. The bond market has been a place of under pressure where bonds have really struggled. There are a lot of risks out there, and geopolitical risks were likely not fully factored into this market. And so in our view, bonds offer a lot of value where risks haven't been fully appreciated.
Yeah, Matt, I mean, given where we have seen bond yields move, we were just showing the 30-year yield hovering just below that 5% level. What has that meant in terms of your portfolio? Are you increasing exposure into fixed income given where yields are?
Yeah, so we have been more intermediate than long duration, but we've been higher quality. That has been a drag up until this point because the lowest credit quality parts of the bond market have been the best performer and the least liquid. In our view, we're looking at high quality bonds now that are yielding nearly 6%. And we're looking to lock that in terms of a yield and income stream for the years to come. We think that's going to be really competitive. And on a risk-adjusted basis, we believe that's going to provide positive Sharpe ratio and diversification benefits from other asset classes. So we continue to look at that favorably. To us, the yield is your best determinant of forward-looking return, and keep it simple. 6% looks really competitive cross asset right now.
Finally, Steen, in the previous segment, we were talking about oil moves that we've seen today, up about 4% in terms of oil futures. And yet this comes on the back of that rapid decline that we have seen on the back of concerns around demand. Do you still see this as just a temporary spike in reaction to the conflict that's playing out, or has the momentum shifted, you think, a bit?
I think technically oil did exactly what it's supposed to do. It had a retracement off the high. The world is still short energy. The world is still dealing with potentially now Iran falling out. Iran has been the main contributor to net growth in supply. The Suez Canal is potentially a transportation way that is very risky. No, there is no doubt in my mind that energy, as it has been over the last 2 years, is somewhere where you both in equity term, but also as a sort of insurance against the unfortunate events that happen to the world, needs to be long. You simply need to be overweight energy. We need it. We don't have it. And more importantly, the insecurity that is now applied to that delivery of energy has now increased significantly. This is even not talking about the potential end game, which is that someone like Russia could weaponize oil over the winter.